discuss this further and what this symposium really means for the US markets and, of course, the impact that it will have across the world. We're now joined by Farah Murad, Senior Market Analyst at the Equiti Group. Thank you very much, Farah, for joining us to discuss this further. Now, promising data we saw from the United States as far as retail sales is concerned. Inflation is also at around 3%. Jobless claims, also the data was encouraging. Meanwhile, very recently, we've also seen Goldman Sachs also revising the risk of a US recession in the next year from 25 to 20%. Does that really confirm Mr. Powell that Mr. Powell will perhaps announce that much awaited rate cut? Is that a given now?
First, thank you for having me. It is a given. The markets are pricing 100% chance to have a rate cut by 25 basis points. So now the question is actually, and what the markets are trying to guess, are we going to a 25 basis points for September or 50 basis points? And I believe that the markets are expecting a dovish surprise. That's why we're seeing this rebound in the market. We're seeing almost a V-shaped recovery in the markets. I'm seeing hedge funds, they're buying the dip in the tech stock. And I believe the data that came in inflation, first time in 3 years, less than 3%. Consumption is good. Maybe they're misleading, if you would like to discuss that as well. But overall, the scenario of a soft landing is the most probable scenario, and that's what the markets are pricing in.
Right. So let me ask you once again, are you expecting a 50 basis point move or lesser than that?
I'm expecting a 25 basis point, not because the markets don't need more. It's just that an extreme move like a 50 basis point might really scare the markets. And that's definitely not what the Federal Bank is trying to achieve, a balance between a strong market and a less inflation. That's the perfect scenario. So that's probably why we wouldn't see a first rate cut that I would say aggressive or a 50 basis point. I don't think it's possible. Even though if you notice today, this drop on US dollar and expectation for the Fed minutes and Jerome Powell's speech, I believe the markets are pricing a dovish surprise. I highly doubt it's the right time for it, but that's what the markets are pricing right now.
Yes, in fact, this will definitely come in as a sigh of relief to investors and, of course, markets in the United States and elsewhere as well, because Farah, rates have been on a decade high for more than a year, and now, expectations are really building up for that much awaited cut. But other than the rate cut possibility, what are the other big expectations, given that an election is approaching and everybody's eyeing what policies will be there as part of the new government?
I mean, we have this tendency to have the sideways movement, a bit of cautious between the investors, even though I think it's an optimistic, cautious behavior. But usually whoever wins, historically, we've seen stock market rebounding after the election. Definitely there's different policy coming in. Sometimes the stock market would prefer wouldn't prefer a Democrat for the first half of year after the election, but overall, over the year, the stock market always rebounds after election.
And absolutely, that's the larger hope. But Farah, experts also say that there is a conjecture around what happens after the first rate cut happens and what will be the pace of additional rate cuts over the next several months as the Fed confronts both risks to inflation and, of course, employment as well.
I mean, inflation is dropping. As I said, first time we're seeing percentage less than 3%. Expectation now is to have probably 100 basis point cut. And if that's right, then we need to see a 50% or 50 basis points somewhere between now and December. This is why the most probable scenario is to see 25 basis points each meeting. That's, I would say, a balanced scenario. A more dovish one would be probably a 25 basis point in September, and then maybe in November or October we would see a 50 basis point cut.
Okay. Farah, let me also ask you, you of course speak about, the inflation numbers that has come in below 3%. And of course, there's other data that's also come in as far as, retail sector is concerned. So encouraging. But will it be right to say that the US economy is completely out of the woods as of now?
No, it's not really the case. And that's probably what some speakers and the Fed, they're trying to highlight. There is some signs that maybe the fundamental of the US market is not as healthy as it shows, or as the recent data is showing, especially in consumption. If you want to check, the credit limit is really being abused. And that might probably be delayed to see how much maybe the US consumer is under pressure, because we're using the credit card, and maybe it's delaying to see how much consumption is being pressured by high inflation. Also, if we remember the last non-farm payrolls, they came really worse than expectation. Unemployment was above even what the federal bank wants. It was at 4.3%. And what's scary with unemployment is when recession comes in, usually it starts with small jump in the percentage, but then it follows with a huge number of layoffs. So that's a scary thing also we need to check if we want to also discuss treasury yields curve. It really hinted to a recession.
Right, Farah. So we've of course, I get your point, but let me, in the interest of time, we're completely running out of time. So let me get in a couple of questions on rising crude prices as well. In fact, we've been speaking to several experts, including Feridun Farashaki, who stated that fundamentals indicate that oil prices are headed anywhere between $85 to $87 per barrel mark, given the demand-supply situation. And of course, the two wars that are raging, and there is escalation on both sides. What is your take on where crude is headed now?
Actually, I disagree with that. Of course, there's a risk, a premium risk of war, premium risk of interruption in the supply chain. But then if I want to check what's happening in the major demand or major economies around the globe, if I want to discuss the US, they are producing in an all-time high. If I want to check data coming from China, there's fear when it comes to demand. OPEC Plus, they discussed this fear. They changed their forecast. Too many other players in the oil market, they can jump in and they can fill the gap. So I highly doubt there might be, or these risks would really create this spike in prices. At the moment, actually, I believe otherwise. I think pressure might continue on oil prices.
All right, so pressure might continue as far as oil prices are concerned due to demand-supply constraints, and of course, two wars raging and escalation being seen on both the Middle East war front and of course the Russia-Ukraine conflict as well. On that note, thank you very much, Farah, for joining us on ET Now and sharing a effect from the big Jackson Hole Symposium, as of course the Fed chair is likely to